Today we're talking about critical business taxes and licenses. Let's get right into our meat and potatoes. Our agenda today will cover two things: taxes and licenses. If we have a little bit of time at the end, I'll also cover tax structure, which is always a fun topic. And hopefully we'll have enough time to cover that. In taxes, there are three types. There's the sales tax, payroll tax, and income tax. And in the business license, there are many kinds of licenses, but we'll probably touch on kind of like the most common that we deal with, that we see in the industry, dealing with food license, liquor license, food stamp, contractor license, and such. So give us some feedback. If you have suggestions and thoughts and want to know more a little bit about the industry that you're planning on going, feel free to send us a message on our website, www.communitycpa.com, and we can do a consultation with you to discuss more about your business interests as well. So don't feel like this is all that we deal with. All right, sales tax. Sales tax. What is sales tax? Sales tax, and later what we'll cover, payroll tax, are two trust funds. Okay, trust funds. Trust funds are taxes that you simply cannot bankrupt from. It is money that you have been entrusted with. In the case of sales tax, from your customer, that you'll be paying the sales tax they paid you back to the government. Payroll tax is the same. It's the same idea as a trust fund that your employees trust you with to remit back to the government. Okay, so you have to first determine, when you go into any business, does my business and my business activity have sales taxable implications? Are my products and services needing sales tax to be withheld, collected, and remitted? To apply, we gave you an example of the state of Iowa. I don't know, you may be tuning in from California, different parts of the country. It's the same. It's usually with the Department of Revenue. Okay, maybe the name is a little different, but Department of Revenue. And you collect the sales tax from your customer and you pay it. You make the payment, and you usually will have to file a report to reconcile the sales tax payments that you made. Payroll tax is the same as well, but sales tax, depending on your size, depending on your state, depends on those things. It changes your frequency. Sometimes we've seen clients pay weekly, monthly, or even quarterly, or even annually. So it really depends on the size of your business and the activity that you have, that determines the frequency in which you make the payment to the Department of Revenue. And the report is also dependent on the state that you're dealing with, but in the state of Iowa, it's done quarterly, every 3 months. So you capture month 1, month 2, month 3 in reconciling those 3 months and sending in a report to capture the periods and the payments that you've made. It's always on the state level. Okay, it's not with the federal. It's not with anybody else, but it's done at the state level. And each state is different. They have different laws related to it, but the trust fund. Payroll tax is like sales tax. It's a trust fund, and its definition is payroll tax that your employers, as an employer, if you're a business owner tuning in, are required to pay to the government entities on behalf of your employee and the salaries that they have. So the common entities, 3 entities that are tied with the payroll tax, are Department of Revenue, like sales tax, and the IRS for the federal level, and then workforce for the unemployment. So those three entities are involved, and yeah, there's different categories within payroll, like the deductions from the employees and the employer portion, right, of the taxes paid based on the employee's wages, and the federal and the state level. So let's go into a example of a payroll. And here you can see a pay stub. This is a pay stub, just a random example of someone's pay stub. And you see the top portion, you literally can break it down, draw a line and fold it in half, right? And you can see the top portion is the employee's portion, and the bottom portion is the employer's portion. And that's how you can make it out to be. But that's $62 at the top, SS for Social Security, MED for Medicare. It matches, right? The 62 and 1450 matches the 62 and 1450 at the bottom, because the employer is supposed to match that. And you make the payment. And what are the differences here? There's the FIT and the SIT, Iowa SIT. FIT stands for what? Federal income tax, right? So that's the employee's portion of the withholding. And Iowa SIT is the state income tax, right? Of the employee's state withholding. And here at the bottom, there are two things that the employer pays that employee does not. That's the unemployment tax, the FUTA. That's for the federal unemployment, the $6 you see there. And then the SUI, right? That's the state unemployment, the $10 there. So that's usually how you can differentiate who pays for what and where that goes. So Social Security, Medicare, Medicaid, those goes to IRS. Federal income tax goes to IRS. State income tax goes to the Department of Revenue, and unemployment goes to workforce. So those are how the payroll segment is divided. So we're going to go right into our other tax, which is the income tax. So there are different kinds of income taxes, right? And I laid it out in this order for a reason, right? Because Schedule C is a sole proprietorship business. Sole proprietorship business. In fact, let me go over our tax structure since we're here, and as it pertains to the different income taxes. So they are in this order for a reason. It is what the IRS consider to be like the organizational growth chart, like this, okay? And sole proprietorship is like a baby, if you will. And partnership is a little bit more mature and in the line. And let's call it a teen, if you will. And then S corporation is a little bit more mature. And it's your college kid who thinks they're independent and files their own taxes. right? But you're still responsible for it, and you take care of. And then the C corp is your grown child. They're married, they do everything independently, have their own kids and everything. Okay, so think of the business in that regard and its maturation. Okay. Um, Schedule C is the sole proprietorship. You can have this entity without creating a business even. You can run it through your social and call it a name. Stan's Lemonade Stand. And you're going to file it in your personal taxes through the Schedule C form in your 1040 personal taxes. This is also same as an LLC that is owned by one person. Schedule C. It's also treated the same in tax world as a sole proprietorship business. Filing under your Social Security, you file everything all in one personal taxes. The income tax you pay is your personal income tax and self-employment tax. Self-employment tax. Self-employment tax is 15% generally on top of your personal income tax. Partnership is an LLC with a partner. So more than one owner of an LLC is a partnership. You file a separate tax return and you divide your net profit equally to the appropriate ownership percentage you might have. And you take the portion of your income and you will apply it into your personal taxes. So the business won't pay taxes. It's in your personal tax level that you'll be paying this tax, you see. And just like Schedule C, you'll pay self-employment tax for a partnership tax. So K1, think of it as a W-2 for business owner. Okay, you're gonna report your K1 through your business taxes into your personal taxes, and all voila in one. In your personal taxes, you'll pay income tax and self-employment tax on your gains for the business. S corporation is a corporation, like the name. It is not something you can just get with the IRS saying, I want an S corporation. S corporation stands for subchapter corporation, and it is, some people also know it as small corporation. And the way to become an S corp is through election. You can elect your LLC to be an S corp, or you can elect your C corp to be a S corp, but it has to go through another form called 2553. It's an election form that can make your entity to be treated as such. And just like the partnership, it has a K1 form. But the difference for the S corporation, rather than a partnership, is that it has no self-employment tax. You don't pay self-employment tax. So as long as you have the word corporation, you won't have to pay self-employment tax. So it saves you 15% there. And why some small businesses, businesses in general, want to be a S corporation. Okay, and something you want to note with S corporation is that you have to have payroll. You have to run payroll to be an S corp. So you have to run officer compensation for yourself. You're the only employee, and run payroll. So that's the only big requirement that people miss when they say they want to be an S corp. They don't know that they need to run payroll. C corporation is a corporation that is not a flow-through entity. So partnership, S corporation, whatever gain you have gets reported to your personal taxes, and your personal taxes deal with taxes, deal with income taxes. Not for C corporation. C corporation is a grown man, it's a grown child. And you have to pay taxes on its own, completely separate from your personal taxes, right? So it's not a flow-through entity. At the end of the year, depending on what fiscal year you're in, you have to pay taxes within the company on the total gain that you have. If you have any loss, then it gets carried forward to offset any gain you might have in future years. So the only connection that it will have with you personally is if you run payroll through it, if you have paid yourself dividend, those type of things you need to report on your personal taxes. Other than that, it gets treated completely separate. Okay. Now, the reason why I told you about this growth chart is that there's a fun study that we've had, and it makes sense logically. This is the order in which we have seen more companies be audited, and versus the companies that we've seen less being audited. So this sole proprietorship, Schedule C, and then the partnership, and then the S corp, and then C corp is the least audited entity. Why? Because a lot of the smaller business owners tend to be in the sole proprietorship area, whereas the C corporation are like the bigger companies like Wells Fargo generally, and Apple, Microsoft, all these huge Walmart companies, and they're all C corps, and who they have that small business owners don't. A lot of CPAs. So a lot of mistakes tend to be found in the earlier stages of the business growth, and so naturally, sole proprietors get audited the most, and C corps get audited the least. Okay, just some fun fact there. Let's talk about business licenses. I know I mentioned that these are just some common business industries that we have come across. And if you have other questions, feel free to consult us separately. But some common business licenses for restaurants are like the food license, like the liquor license, if you're a restaurant. If you're a grocery store, you can tag on a food stamp there, and convenience stores, I know it's not on here, also have like the lottery, tobacco, those type of licenses, and nail and hair salon. There's the salon license that you need to get, and for construction business, you need to get like the contractor license. And every business is different, and possibly can't cover all the different types of businesses that are out there, but every state is also different. And so I just wanted to share some brief highlight stuff here, but feel free to check with your type of business that you're planning on starting or having, and make sure that all things are covered. You know, nothing worse than coming across a client that just was so eager to start their own business, and they brought their lease over to me and said, Dan, I'm ready, and I got the lease and everything, and I've been waiting for 10 years to save up and run this, you know, liquor store, and been a dream of mine. And later found out they're not zoned for that location. And my goodness, it was a mess. They couldn't sell liquor at the liquor store because they were not zoned properly to sell liquor. They had to go through the city and apply for zoning and get permission. So have to do your studies in order to make sure that you don't waste time, and time is money, and you get right there up and running when you need to. Okay. So always consult a professional before you start your business or make big business decisions. And to properly scale and grow your business is all about knowledge. Coming to these webinars, free webinars, we provide day in and day out for our clients and for our potential clients. Just come up here and check it out to make sure that your knowledge is being expanded and being up to date with what's going on. And we know that you'll be successful.